So that was kind of the beginning of where fiscal started to become relevant. So that was a mix of monetary and fiscal response, because that was a private sector debt blow up for the most part. And so the biggest response there was monetary.
Hello everyone, and welcome back to Finance Wolf. In this video, Lyn Alden talks about cryptocurrencies and Bitcoin. Bitcoin as well as stablecoins have significant influence. Tools for addressing this issue, for example, can have a big impact in developing nations. People may prefer a Nigerian graphic designer who can easily send a payment via email or direct message, or present a QR code during a video call. They can also choose to pay in any currency they want, avoiding the local banking system. This method offers enormous value and works on a peer-to-peer basis, avoiding centralized gateways. Holding and transferring assets is important in this process, and it's important to take jurisdictional risk into consideration. Lyn Alden covers a lot of these topics, so please.
Size of the fiscal deficits that year. And especially when you kind of look at that over any, say, rolling 5-year period. And so basically more money's coming because banks are lending. And the reason that was happening, there's a bunch of reasons, but basically the baby boomers were entering their home buying years. So you had a big demographic surge, a lot of people kind of hitting their period of peak credit formation. And back then houses were cheaper, so people could buy homes earlier. They bought them often in their 20s or, sometimes early 30s, but they could start buying homes on average earlier than people do today. So this big generation's coming into their home buying years, their family formation years, this kind of peak credit formation. Banks are making a lot of loans. You have money supplies going up very quickly. And then you ran into price inflation because you had that higher than normal rate of money creation at the same time as you had obviously constraints in oil supply, and we're also running some background deficits that weren't helping, even though they were a smaller force. And the way to get that under control was that Paul Volcker, the head of the Fed, raised interest rates to the highest level they've ever been in the United States. And the reason that was effective was because the federal government only had 30% debt to GDP. So there was not a lot of debt on the public sector, and there really wasn't even a ton of debt on the private sector, but he was able to raise rates super high. And what that did was that slowed down borrowers wanting to borrow money. Who wants to borrow money at double digits, especially if that's much higher than the inflation rate? So real high nominal rates and real high rates compared to the kind of measures of inflation. And so that really slows down the ability and the desire for people to borrow money, and it slows down that rate of bank lending. It kind of pushed the economy into a credit contraction recession. But you kind of wash out some of that inflation from the system. You kind of reduce demand enough to allow supply to catch back up to it. And so that's an example of monetary dominance in action, both the cause of inflation and then the response to having that high inflation. Whereas another big inflationary period in the US was the 1940s. And people don't really think of that decade when they think of inflation, but that was roughly on average as inflationary as the 70s. But that was the last time we were in fiscal dominance. And so in the 40s, banks were not lending much at all. That was not a period of rapid bank lending. Instead, the obvious context was World War II. And so they had already gone through the Great Depression. So they already had the big private debt bubble pop, and they started rotating that more to the public ledger. They kind of got stuck in this period of stagnation. But then, as populism grew around the world, partially because of economic reasons, war broke out. And when it came to war, they did these massive fiscal deficits, the biggest deficits relative to GDP we've ever seen. They were even bigger than what happened in the 2020s. And a lot of that goes to fighting the war, but that's going to commodity development. That's going to manufacturing. When the GIs come home, you put them through college and technical school and subsidize their mortgage, and it's it's this kind of
government spending programs, basically.
Exactly, yeah, really big stimulus in various ways, and it's a lot of that. The bonds they issued to fund all that, because it's a tremendous amount of bonds. They were bought by the Federal Reserve, increasing their monetary base. Then they were bought by the commercial banking system on fractional reserve leverage, and so you had this huge spike in the money supply. But it was not because banks were lending. It was because these really big monetized fiscal deficits were plowing money into the system. And the Federal Reserve, they were basically captured by the Treasury. So they kept rates low, despite the fact that inflation was very high, because if they raised rates, it wasn't going to change the decision of Washington they're not going to not go fight this battle because of what the Fed's doing. They're not going to change any of that. And so it's an entirely different tool set around that. And so eventually after the war, they pivoted more toward austerity, and they had a number of kind of things in their favor to grow out of that problem. But that's an example of fiscal dominance at its most extreme. Whereas the 70s was more so a monetary dominance. And today in emerging markets, you see often there is fiscal dominance happening. Probably the clearest case of fiscal dominance today is Japan. So they have over 250% debt to GDP. Bank lending is not at a very high rate at all. It's some of the lowest rates of bank lending in the world. Their money supply increase, it is still fairly slow, but the increase that does happen is largely because the government's running deficits, and then the central bank is helping to monetize those deficits. And so higher interest rates have a mixed success record of dealing with that, because it's not like they're going to change their government spending much based on what the central bank does in the same way that the private sector responds. And so I think that's kind of a good baseline to set it is where's the money creation coming from, and what tools are able to slow down or not slow down. So that was kind of the beginning of where fiscal started to become relevant. So that was a mix of monetary and fiscal response, because that was a private sector debt blow up for the most part. And so the biggest response there was monetary, mainly in the form of cutting interest rates to zero and then doing quantitative easing. There were some fiscal components, but as you pointed out, they were more targeted on banks. So some of the bank bailouts involved a combination of monetary and fiscal policy, because they did things that the Fed is not authorized to do on their own. And so some of that was actually injecting solvency into the banks, not just liquidity, but the other part was monetary. To the extent that there was fiscal support to the rest of the economy, that was pretty minimal. So, for example, there was things like cash for clunkers.
I do remember this. That was like it was a government program to like buy your used car. Was that what this
Yeah,
was?
it's basically it incentivized people to get rid of their older car and buy a newer car, and try
Right.
to help them out while also helping out kind of industry. But that was, that's like basically laughing stock in terms of size compared to the things we saw in these recent years. There were also, I mean, they gave a little bit of a boost to seniors. It was like a tiny little stimulus check. If you were unemployed, your benefits were a little bit higher than normal. So around the margins, there was a little bit of fiscal support, but more of the fiscal support was directed at the banks to recapitalize them. And then it was a very large monetary response. And when you look at another way to phrase it is, what is the fiscal support relative to? So for example, during that kind of 2008, 2009 period, a lot of loans went bankrupt. So they defaulted. And one of the few ways to really destroy money in the system is to default on a loan, or pay back a loan and don't refinance it, actually pay it back. Those are methods to either rapidly or slowly reduce the amount of money supply in the system. And so during that period, because of loan defaults, the money supply would otherwise have shrunk a little bit. And the fiscal support that they did was about the same size as the loan defaults, and also just a slowdown of lending that occurred. And so they basically balanced it in such a way that instead of getting deflation, we just had like zero inflation, or like really low inflation. You might have had like a couple quarters of the way they measure it, deflation. But it wasn't like some gigantic, huge thing that was way bigger than the amount of loans being destroyed. Whereas when you fast forward to say the 2020s, these stimulus checks were, order of magnitude bigger. The stimulus checks, the child care tax credits, the PPP loans that turn into grants, the corporate bailouts, down the line, all these kind of things that happened, and the magnitude of those was way bigger than the loan defaults. And so that was a net huge increase in the money supply in a way that did not happen in 2008. So 2008 was like hints of fiscal, still mostly monetary, whereas by the time we got into the 2020s, monetary policy is still a present force, but the fiscal side is so much larger.
Lyn, is this too simple an explanation?
According to historical data, Bitcoin looks to have successfully navigated the potentially dangerous period that followed the recent herring event. A crypto analyst recently shared an update on the Bitcoin market cycle, mentioning that the danger zone, which occurred when the asset corrected after a significant event, is now over. Bitcoin is now entering a phase of reaccumulation. Bitcoin saw a strong bounce from the reaccumulation range low support. The analyst also pointed out that similar danger zones have happened in past market cycles when the asset retreats on either side of the event in this cycle. BTC fell 23% from its peak price in mid-March to $56,800 on May 1st, possibly indicating the bottom of the PO having danger zone period. The analyst believes that if $56,000 was not the bottom, then this current pullback will have officially equaled the longest retrace in this cycle at 63 days. However, historical patterns suggest that the current pullback ended at $56,000 after 47 days. If this video was helpful, please like it, and please subscribe to our Finance Wolf channel. We hope to see you in the next video.